Barry, good to have you with us again.
Thanks for having me.
Can you just quickly go over your unique approach to investing, which seems to combine technical and fundamental? Roughly, what is it? How did you come up with it? And how have you refined it?
Sure. We run a moderate slug of money. We use an asset allocation model. We have a number of different inputs that go into our model. We use fundamentals to help us determine what to buy. We use
fundamentals would include
macroeconomics, what's happening in the earnings picture for specific stocks, the various sectors, the stories that are involved in that. That's really the what to buy. The technicals, things like trends, market internals, the quantitative inputs that we use, that helps us with the overall timing. And then the umbrella on top of that is a tactical overlay that says, all right, now's the time to become more aggressive, either because of valuation or other factors that make markets attractive, or now's the time to be a little more defensive, have a little more bonds. You know, the benchmark we look at is a 60-40 split between equities and fixed income. We came into the 2012 overweighted equities, and we've slowly pared that back just to about our benchmark now at 60-40, and we're watching to see how much more to pare back. The challenge these days are none of those inputs are driving equities. You can throw all that out. It's pretty much central banks, the Fed, intervention, Operation Twist, QE, God knows what. And so it makes very challenging the concept, the role of trying to look at equities in the market and make intelligent risk decisions.
On getting to the particulars of your approach, PE ratios you don't like, why?
Well, it's not that I don't like them. It's that people have a tendency to pull them out of context and say, this is a great company. Look how cheap the PE ratio is. If you only looked at PE ratio and ignored things like growth rates and what's going on beneath the surface at the company, you would never have bought Apple because it was too expensive 5 years ago. It was trading at a 60 or 70 PE. It's since gone up 1,000%. You would have stayed away from Google, which quadrupled in that period. But you would have loved the home builders in 2005 because they were, even though they were at a peak in their profits and their sales, and the real estate market was peaking, they traded at a single-digit PE. In 2006, that could have gotten you into the money center banks, and in 2007, that could have gotten you into the big brokerage firms. They all were cheap based on PE. There has yet to be found a single variable that you can say, based on this metric, I can buy this and sell that. It's far more nuanced and complex than that.
Talking about single-digit PEs, you see those for the big oil companies, you see them for the money center banks. Is that a sign, get away from them if you're not already away?
I don't think it's a sign to get away from them. You know, the big oil companies, and we own ConocoPhillips, and we have a smidgen of ExxonMobil. ConocoPhillips is kind of a special situation with their recent spin-out. Look, the energy companies are going to be here for a while. I'm not a believer that we're going to be moving to batteries, to wind power, to solar anytime soon, and that's just strictly a function of what it costs to generate a kilowatt of energy with each of those technologies. Hey, one day we'll have this huge breakthrough in solar. I mean a Manhattan Project, atomic bomb type breakthrough, and solar will see its output quadruple, battery storage will go up tenfold, and then suddenly solar will be really competitive with oil. I would bet that that's going to take longer than 5 years and less than 50 years. So somewhere in the next half century, solar is going to be dirt cheap and oil is going to look a little pricey and oil companies look pricey. But that could be 10, 20 years away. Money center banks are a different situation. We still have no idea how much junk is on their books because they asked for and got permission to more or less not disclose that through FASB 157. If you look at the state of, we mentioned the Fed earlier, ultra low rates, what they're doing for mortgage costs, what's been happening in terms of capital ratios, things like that. All of this slow, gradual repair, all of these bailouts have been to give the money center banks a decade or so to rebuild their balance sheets to get healthy, because they just gorged on bad debt, as did so many different sectors of the economy, and it's going to take a while to work that off. The good news is it's 2012, so maybe we're halfway through the process. At a certain point in the future, I can't tell you if it's 1 year, 3 year, 5 years, money center banks will be really attractive, but we're not quite there yet. The best in breed, JP Morgan, if even they're doing silly stuff on their trading desk, then what hope do you have for the other money centers? Now, the smaller community and regional banks, they're cheap and they're much more attractive to us.
Even Dodd-Frank crushing them with thousands of new rules?
You know, I call it the Accounting and Lawyer Full Employment Act. And if you're running, Bill Dunkelberg is head of the NFIB, and he has run a number of small banks. And I just was fishing with him up in Maine last week. And when we talk about community banks and small banks, if you're running a 2 or 3 branches, Dodd-Frank's just crushing. But if you have a bank and you have a dozen or 2 dozen or more, you have a legal department, an accounting department. The fascinating thing about a lot of these regulations, it all becomes boilerplate. They create the first version, and then it's just rubber stamped, and this stuff goes through. And it's not, you know, it's not like they have teams of hundreds of lawyers doing this, but it is an expense. They do have to handle it. It's much more efficient to spread that out over 50 or 100 branches over a few $100 million or a few billion in assets than it is for a small corner bank. And by the way, that's why a lot of the small single branch or multi-branch community banks have been petitioning for exemptions. It's crushing to them. Hopefully these guys will be let out from under it just based on their size, or we'll just see a wave of small bank, community bank mergers till they get to the point where they're able to do that efficiently. It's impossible for these guys to compete with the giant money center banks. Dodd-Frank, as much as people complain to a Bank of America or a Citigroup, it's a rounding error.
Now, Dodd-Frank, does that just perpetuate the complaints you had 3.5 years ago about the banks?
Pretty much. I mean, my attitude is, I know this is out there, and I remember the conversation we had way back when. If an entity in the United States, a corporate entity, is insolvent, well, that's why we pay bankruptcy judges. In fact, it's about 20 blocks that way. You go to the bankruptcy court, the management of the company loses their job, the shareholders get wiped out, and the bondholders take a haircut. And what comes out of bankruptcy is a cleaner, healthier financial institution. If we look at, forget Iceland, which is so small, but even Sweden, if you look at what Sweden did during their banking crisis, it was a relatively rip the Band-Aid off, painful couple of quarters, and then they've rebounded very nicely. In fact, Sweden has come through the most recent financial crisis as well as anybody. Compare that to all the extra...
Sweden's been cutting taxes, too.
Well, you know, it helps if you're not spending hundreds of billions of dollars taking crony capitalists. You know, the great Alan Meltzer quote is, capitalism without failure is like religion without sin. It just doesn't work. And in the United States, we have a financial sector where, you know, there's no failure, no matter how big a company seems to be or how bad they screw up. As long as I have a friend in DC, the money keeps flowing. When researching Bailout Nation, the astonishing pattern I noticed...
book you published 3 years ago.
Right after the collapse, these giant bailouts, they always seem to happen in a presidential election year. Why is that? Because these guys aren't the most deserving entities. They just happen to be companies who screwed up, but they have a politician buddy in Washington, D.C., and hey, what's a few $100 billion between friends?
One other technique you use on the technical side is stop-loss orders.
Always. Look, it's a form of, well, there's 2 factors that go into it. The first is, you know, if you're a baseball hitter and you're hitting 400, if you're Ted Williams, you're the greatest hitter of all times. If you're a stock picker and you're wrong as often as you're right, people think you're a bum. But it's not how often you're right or wrong. It's how much do you lose when you're wrong and how much do you make when you're right. So you could be wrong frequently. I'll give you a perfect example. I am not a fan of Facebook. I don't like the business model. I wrote a couple of very critical columns saying they were widely overvalued. I thought the IPO price was just $100 billion was absurd. But in this business, you're always trying to anticipate not what you believe, but what everybody else thinks. And the day of the IPO, we bought Facebook under $40 on the assumption that, hey, I'm wrong and everybody else is right. And so this is going to go to 60, and I shouldn't punish my clients because I don't care for the company or its valuation. By the end of the day, it traded right down to the IPO price, about $1.50 less than we paid for it. And it appeared to me the sponsors, the underwriters, were supporting it at 38. And with very little time left in the end of the day, we cut loose the position and said, my thesis is wrong. This is not going to be supported after the IPO day is over. We took the stop loss, we moved on, and now the stock is 40% lower. So you can come back from lots of 3 and 5 and 7% losses. Really hard to come back from a 40, 50, 60% loss.
So this gets to your monkey theory.
Okay, yes, absolutely. It's us humans are slightly cleverer, pants-wearing primates. We're motivated by the same thing. We want a banana. And sometimes we do really stupid things in pursuit of those bananas. And as an investor, we talk about humility. You have to recognize that not only are you going to be wrong, but sometimes you're going to be spectacularly wrong. And so you have to be willing to admit the error, move beyond it, and try and find a better opportunity. You can't let your ego, you can't let your emotions play into it. A number of studies have found that women tend to be better investors than men because, if it's not working out, they cut the loss and move on, whereas men don't want to allow the ego to say they were wrong. They tend to try and stay with
directions.
Exactly. It's so I live on the North Shore of Long Island, and we were just talking about this school of dolphins that found its way to Hempstead Harbor, way off their usual route. And the joke was, well, the male dolphins didn't want to stop and ask directions. But
now, one of the things you have said, the less you do, the better.
Yes.
Activity does not create value, always.
That's right, for 99% of the people out there.
And yet some of your portfolios engage in a lot of activity. How do you?
Well, when you say a lot of activity, we tend to try and hold stuff until it misbehaves. So on the one hand, and in this choppy, range-bound environment, you tend to have more turnover than I prefer. Look, the reality is the more trading you do, the more friction, the more taxes, the more fees, the more likely you are to be wrong. So less is more. The flip side of that is, hey, if you're sitting on train tracks and you see a locomotive coming, you don't have to sit there because, hey, I don't want to overtrade. Sometimes you have to honor those stop losses, and in fact, all the time you have to honor those stop losses and get out. So it's a balance between identifying opportunity, being patient with positions and letting them play out, versus, hey, this is a really difficult environment. It's already moved this far. We call it a prenup. Every position we have a signed prenup with it, and when we catch the position in bed with the pool boy, out it goes.